Hi everyone, welcome to another video on this channel. As you all know, the purpose of this YouTube channel is to explain the basics of mutual funds and the basic concepts in a very simple and easy to understand way to new mutual fund investors. My name is Paresh. I am an NISM certified and AMFI registered mutual fund distributor and advisor. This is my ARN 334516. Today we are going to look at what is widely known as Japan's lost decades. Now, this video is not really about any particular mutual fund category or any particular mutual fund scheme, but we are going to look at the economic crash in Japan in the 1990s, the catastrophic effects it had on the country's stock market, and what we as individual investors can learn from this whole episode. Before we move ahead, this disclaimer is extremely important and highly relevant, for today's video. Mutual fund investments are subject to market risk, and you need to read all scheme related documents carefully. So this is what Japan's real GDP growth looks like over the last say 70-75 years or so. So if you look at this graph, right? So from around say 1955 to 1973, so that's nearly 18-19 years, the country averaged around 9.3% of real GDP growth, and that's a fantastic number. As you all know, Japan was completely destroyed in World War II. Two atomic bombs dropped, Hiroshima and Nagasaki. So the country was in a rebuilding phase after World War II, and the Japanese worked really hard. Right, the Japanese work ethic even today is known across the world for their attention to detail and obsession about quality. So during this period, Japan was rapidly industrializing. Right, the manufacturing sector grew fantastically well. The Japanese companies were known all over the world for their product quality. The Japanese company actually gave the world of manufacturing several quality management frameworks. Things like just in time or Six Sigma. They were invented by Japanese companies. So this was like a golden period for the Japanese economy. 9.3% of CAGR over 19 years is an excellent economic performance. And then there were certain geopolitical events or economic events, and we are not really going to go into the details of those because this is not really an economic session. We are more concerned about how the economy, Japanese economy, progressed or crashed, and what was its impact on the country's stock market. So from say 1973 to around 1985, the economy grew at around 3.9%. Obviously, you're growing on a high base, so it is expected that the growth would eventually slow down. And then there were something called as Plaza Accords, and these were basically the dollar was devalued in relation to yen, and which actually caused an economic boom in Japan. It led to a lot of asset price bubbles. We'll see in the later slides. And then somewhere around 1991, 1992, the entire economy crashed, right? Because all those asset bubbles which were created in the last say 10 years or so, uh, all came crashing down. And after that, for about a decade, so from say 1992 to around 2002, the average growth rate of Japanese economy was around 1.3 to 1.5%. The decade after that, the economy was almost stagnant. The average growth was around 0.5% annum. And even after a decade after that, so from say around 2013 to say 2021, the growth rate was around 1%. So these 3 decades, after the economic crash that happened in around 1991, 1992, are collectively called as Japan's lost decades. Why? Because the economy just didn't grow there. If you look at the line, is almost flat, 1.7%, 0.5%. These are not really commendable growth rates, especially for an economy which was growing at around say 5% prior to that. So this is what happened in terms of real GDP. Now let's look at the impact of this on the country's stock market. Now this is Japan's Nikkei index, right? So just like in India we have Sensex, we have Nifty. In Japan, for the Tokyo Stock Exchange, they have their index is called as Nikkei. So Nikkei reached an all-time high in December 1989, and after that it crashed about 50% in 1 year. And look at the level of that index. It did not recover for almost 35 years. Somewhere in Feb 2024, it regained its all-time high, which was hit in December 1989. This is actual data. This is hard data. This is not, an opinion. This is not a view. Okay, these are hard facts. Right? And and look at what happened prior to December 1989. Right, the index almost grew three times in three and a half years prior to that. So there was a huge stock market boom in Japan. As I told you, there were asset price bubbles. So stock market or equity is just one asset class. There were bubbles in almost every other asset class. Land, real estate, arts, or any other asset class. There were huge bubbles in that, and it all came crashing down, and the stock market remained below all-time high for nearly 35 years. So just imagine if you had bought the Nikkei index in December 1989 as a retail investor, or as an individual investor. If you had bought an index fund, right, for the Nikkei index in December 1989, your investment would have dropped by half, which means you would have seen 50% loss in your portfolio within 1 year of investments, and your investment would have been in deep losses for nearly 35 years. Your portfolio would not have recovered for 35 years. And this is not an imaginary scenario. Just imagine, just put yourself into the shoes of a retail investor in Japan, okay, somewhere in, say, at the beginning of 1989. You must you have read all those headlines, right? The stock market is booming, the wealth has been created, so much billions of dollars have been created in wealth. You have seen probably your friends and relatives who are investing in stock markets, either directly or mutual funds, bragging about the IRRs that they got, that I'm getting 30-40% return a year. They're probably using the profits to buy new houses, flashy cars. So obviously it's quite natural for you as a retail investor somewhere in, say, Jan 1989 or even June 1989, to think that, okay, this stock market is now only going to go up, given that it has almost tripled in the last three and a half years. The stock market is only going to go up. So you invest, okay, somewhere in uh, June 1989 or even December 1989, you invest in an index, or even any other, for that matter, any other equity. And within a year, your investments have lost 50% in value. This must have happened to thousands of investors in Japan, and then that investment did not recover fully for almost 35 years. The purpose of this graph is to tell you, when stock market crashes, it can crash so badly, and then it can remain below the all-time high for so long. So what caused this economic and stock market crash? See, the economic tanked first. Although the stock market reflected the economy, the stock market tanked in 1989. The actual economic crash happened in around 1991, 1992. So first and foremost reason is the asset price bubble, right? So the land and real estate prices in Japan were rising at phenomenal rates, right? So the average Tokyo commercial land price appreciation was 42% in 1985 and 122% in 1986. And land or real estate was just one of the asset class. Okay, the stock market was hitting record highs, almost every week. There was uncontrolled credit expansion. Okay, in the 1980s, Japanese banks started lending against land as collateral, and since land prices were rising, the loan values kept increasing. For the same amount of land, you could probably get a much higher loan amount, because your land prices were appreciating year on year, right? After the economic crash, land prices obviously started to decline, and banks began to accumulate bad loan assets. Because why? Because earlier they had lent against a collateral whose worth was, let's say, 1 CR, and suddenly that collateral is now worth half that. Right? So once the borrowers start defaulting, the banks have no recourse. Even if they sell the collateral, they will realize probably half or even less than that, the value of that, right? And another important reason was lax monetary policy. The central bank of Japan, or the government, obviously knew that there were asset price bubbles, but they kind of did not act on them soon enough, right? So there was excessive monetary easing. The central bank did not raise the interest rates soon enough, And through the creation of economic policies that cultivated the marketability of assets, eased the access to credit, and encouraged speculation, the Japanese government started a prolonged and exacerbated Japanese asset price bubble. So, in addition to the 2 points mentioned above, asset price bubble and uncontrolled credit expansion, there were certain other products which were launched by the government or by the banking industry. uh, these products are too complicated to go into for this video, but they basically encourage speculation. So there was kind of a circular route, right? So you borrow more to invest in stocks, and because the stocks are going up, you borrow even more and then put them and invest that money in stocks. So there was a circular kind of a loop which kept raising the stock market prices to unsustainable levels. So, what can individual investors learn from this? Now, remember, whatever you saw on the previous slides, these were not opinions, these were not views, these are hard facts. Okay, this is exactly what happened. So the first thing that you need to realize is that equity is a highly risky asset class. So the disclaimer which you see, which is there on almost every video on this channel, and I keep repeating it, and because there is so much repetition, maybe people don't take it seriously. The first look at the first line: mutual fund investments are subject to market risk. Now, these are the market risks that we are talking about. Market crashing by 50% and then remaining at that level for almost 30-35 years. This is a market risk, right? And remember, this happened in Japan is not some small, undeveloped, corrupt kind of a country where there are no laws and regulations. Japan was a rapidly industrializing country back in 1980s. It was widely seen as the competitor to the USA in terms of economic might, right? So if crises like these can happen in Japan, they can happen anywhere. Okay, if stock market crashes like these can happen in Japan, these can happen anywhere. We as individual investors need to keep that into mind, that stock markets are not going to keep rising forever. Just because last 3-5 years stock market might have given fantastic returns. I'm not just talking about India. I'm talking about any other stock market for that matter. Doesn't mean they will keep rising in the near future too. Another point is that stock market crashes can last far longer than anyone can imagine. So 34 years is a long period. It's like a lifetime, right? Uh, so don't think that if there is a crash tomorrow, the market will recover in a year or so. It may recover. It might take 5 years, 10 years. Nobody can predict that. Third point is that past performance is no guarantee of future. Remember, the Japanese index Nikkei grew almost 3x, 3 times in 3 years before the crash. So just before the index crashed, for the last 3.5 years, the index has almost tripled in its value. And the important lesson is that diversification is must, right? You cannot put all your eggs in one basket, which means you cannot put all your investments into equity. You have to add debt, you have to add commodities, gold, silver, etc., and fixed income investments like fixed deposits, government schemes, etc. On this channel, there is another video which I've done about multi-asset allocation funds, and you should probably have a look at that video and this category of mutual funds, because it adds various asset classes like equity, debt, gold, silver, commodities, etc. So your money is diversified across many other asset classes. See, if you are young in your 20s, you can probably go for all equity mutual funds, pure equity mutual funds. But once you cross a certain age, it could be 35, 40, depending on your financial situation, you have to diversify your investments. You cannot keep putting all your investable amount or investable corpus into just equity. The next important point is that you must have a very long term horizon when investing in equity, right? So you need to have at least 10 plus years of investment horizon if you're planning to invest in direct equity or equity mutual funds. See, the crashes like these, nobody can predict, right? And how long, once the market crashes, how long will that last? Nobody can predict. So there is another video on this YouTube channel about small cap mutual funds, and you should have a look at that, right? Because over in that video we covered what happened in 2008, especially when it comes to small cap index. During the 2000 stock market crash, when the index crashed, I think it crashed by something like minus 76%. So okay, so in Nikkei crashed 50%. In I think 2008, during the bear market, the small cap index crashed by something like 75%, and it took, if I remember correctly, around 65, 64, 65 months. So it took 5 years more than 5 years for the small cap index to recover, right? And that was small cap, but here the Nikkei is not a small cap index, it's the frontline index, which means these are some quality companies. And even then, even after having such quality companies which are known worldwide, their stock prices crashed by almost 50% and remained at similar level for nearly 30-35 years, right? So another important lesson is that do not invest your emergency funds in equity, right? So you need to put aside certain emergency funds. So if you are working, you can probably think about putting the next 9 to 12 months of your expenses into, say, a fixed deposit, or even a savings bank account, just in case there is an emergency. But never invest those funds in an equity mutual fund. Okay, at the most you could invest in a liquid mutual fund scheme. What are liquid mutual fund schemes we will cover in future videos. But remember, whatever money you want to keep for emergency, never put it into any equity mutual fund. And finally, do you remember the 3C framework by Peter Lynch? Okay, there is another video on this channel wherein I covered some advice for mutual fund investors by legendary investor Peter Lynch. Peter Lynch is the most successful mutual fund manager in the history, not just in America, but anywhere in the world. So he's the most successful mutual fund manager, and he had something called as 3 C's of unsuccessful investors. So the unsuccessful or unwary investors pass in and out of these three emotional states: concern, complacency, and capitulation. Right. So when the Japanese investors who probably entered the stock market in the 1987, 1988, or even 1989, they were in the complacent phase, right? The second point over here, because they were buying a bull market and the prices kept increasing. So they should have been concerned at that point of time that why is the stock market tripling over just 3.5 years? Is there a real economic reason, or is this a bubble? Right? So they should have been concerned, but they became complacent, and most of them probably paid the price, because this market crashed and remained below the all-time high level for 30-35 years. So this is the important thing. Okay, if you are not seeing that video, I suggest you go back to that video on this channel and watch the Peter Lynch advice video, right? In addition to that, there are many fantastic pieces of advice which Peter Lynch has for us. But remember, avoid being complacent, right? So be careful when asset prices suddenly increase without any real reason or real change on the ground. So if you see, your mutual funds or any investment, whether these are mutual fund investments or direct equity or any other investment, suddenly if you see, they have jumped twice, okay, or thrice in a short period of time, you need to evaluate whether this kind of appreciation is justified. Is this a bubble, or is there a real economic reason behind that? So that's why you need to do a periodic review of your portfolio, say monthly or quarterly. By periodic, I don't mean daily or even weekly. And you should ideally do maybe a monthly, a brief review on your own first, and if you have any doubts, you contact your advisor, right? And if you see these sudden spikes, you need to take a call, right? I'm not saying you should redeem your investments, but take a call. Okay, can we diversify some part of it? Can we shift some part of this to a, say, a debt fund? Can we shift some part of this to a hybrid fund? Talk to your mutual fund advisor. Do you think the markets are overvalued? Do you think these kind of price rise, you know, price rises or investment return multipliers are justified? Should I move some part of my profits to, say, a debt fund? Should I move some part of it to a hybrid fund? Should I probably add another category of mutual funds to my portfolio, such as a multi-asset allocation fund, given that equity prices are at an all-time high? And finally, don't be afraid. Okay, the purpose of this video was not to scare you from equity investing, but rather to make you aware of the risks and why you should stay invested for a long period of time, right? Uh, Equity markets, see, equity as an asset class has always outperformed all other asset classes over a long period of time, and this is a data which is validated all over the world, and even in Japan it is validated, right? So somebody who had invested in, let's say, 1990s, that person today would be sitting on, say, 1995, 1996, that person today would be sitting on good amount of gains. It's only those who invested right at the peak of the market have really suffered, and it took them nearly 30-35 years to kind of recoup their losses. So Now, this is an extreme example. What happened in Japan was an extreme example, but remember, this is not a theoretical example. This can happen anywhere. If it can happen in Japan, it can happen anywhere, right? So you need to be prepared for these kind of volatilities. You need to be prepared for these kind of crashes when you're investing in mutual funds, and you need to be an informed investor, right? So you, not everyone amongst you may know the basics of stock market investing or economics or asset price bubbles and all that, but you can still take some interest and some calculated risks when it comes to investing in mutual funds. Diversify, make sure that you're checking your portfolio periodically, and make sure that you are not putting all your funds into equity mutual funds. So this was the gist of it. If you want to begin your mutual fund investment journey, you can contact me on this WhatsApp number 9757309269. On the right hand side, you can see a QR code. You can scan that using your mobile phone and download the Funds Bazaar app, register yourself on that app, and start transacting in mutual fund schemes. All the mutual fund schemes which are available in the market are available on this app. If you're not comfortable using an app, there is a link which is given in the video description, which will take you to the Funds Bazaar website, and you can do the transactions on the website. Thank you for watching this video. Bye.